Accounting and financial ratios. Introduction to financial ratios. Financial ratios are analytical tools that use data from financial statements to assess a company's performance and financial position. Financial ratios provide a standardized way to compare companies of different sizes, industries, and across different time periods. Importance of financial ratios. Financial ratios are important for several reasons. They facilitate comparison between companies or industries. They simplify complex financial data. They can be used to identify trends over time. They highlight areas of strength or weakness in a company's operations. They allow for quick assessment of a company's financial position. They aid in decision-making for investors, creditors, and management. Financial ratio categories. Financial ratios fall into several categories, each of which we will discuss. The categories are: 1. Liquidity. 2. Profitability. 3. Leverage. 4. Efficiency. 5. Market value ratios. Let's take a closer look at financial ratios. Liquidity ratios. Liquidity ratios measure a company's ability to meet its short-term obligations, that is, whether it is able to pay for current operating expenses and service debt. Key liquidity ratios include current ratio, quick ratio or acid test ratio, and cash ratio. Let's take a deeper dive into liquidity ratios. Current ratio. The ratio is current assets divided by current liabilities. The current ratio measures the amount the company has in current assets for every $1 in current liabilities. A good current ratio should be above 1. Quick ratio or acid test ratio. The quick ratio is current assets minus inventory divided by current liabilities. The quick ratio measures a company's ability to meet short-term obligations without relying on sales of inventory. An ideal quick ratio should be above 1. The quick ratio is a more conservative measure than the current ratio. A company could have a quick ratio below 1 and still be able to meet its short-term obligations. The quick ratio varies by industry, and companies in some industries will be able to meet their short-term obligations despite a lower than average quick ratio. Cash ratio. The cash ratio is cash and cash equivalents divided by current liabilities. The cash ratio is the most conservative liquidity ratio and shows a company's ability to pay off short-term debts immediately. Ideally, the cash ratio should be between 0.5 to 1 to be considered good. The cash ratio varies by industry, and some industries will still be able to meet their short-term obligations despite a lower than average cash ratio. Cash conversion cycle, CCC. The cash conversion cycle measures how long it takes for a company to convert inventory back into cash. Cash conversion cycle equals days inventory outstanding plus days sales outstanding minus days payables outstanding. Profitability ratios. Profitability ratios are used to assess a company's ability to generate profits relative to sales, assets, and equity. Key profitability ratios include: 1. Gross profit margin. 2. Net profit margin. 3. Return on assets. 4. Return on equity. 5. EBITDA margin. Let's take a closer look at profitability ratios. Gross profit margin. Gross profit margin equals revenue minus cost of goods sold divided by revenue times 100. Gross profit margin measures the percentage of revenue that exceeds the cost of goods sold. A higher margin indicates better efficiency in production and pricing. Net profit margin. Net profit margin equals net income divided by revenue times 100. Net profit margin shows how much profit is generated from each dollar of sales. Return on assets, ROA. Return on assets equals net income divided by average total assets times 100. ROA measures how efficiently a company uses its assets to generate profits. Return on equity, ROE. Return on equity equals net income divided by average shareholders' equity times 100. ROE indicates how effectively management is using shareholders' investments. EBITDA margin. EBITDA margin equals EBITDA divided by revenue times 100. EBITDA means earnings before interest, taxes, depreciation, and amortization. EBITDA strips out non-operating expenses such as interest and taxes and non-cash expenses such as depreciation and amortization, and is a better reflection of how the company's operations are performing. Leverage or solvency ratios. Leverage or solvency ratios are used to evaluate a company's debt levels and ability to meet financial obligations. Key leverage ratios include: 1. Debt to equity. 2. Interest coverage. 3. Debt to EBITDA ratio. Let's dig a little deeper into leverage ratios. Debt to equity ratio. Debt to equity ratio equals total liabilities divided by shareholders' equity. Lower debt to equity ratio means the company has less financial risk. Interest coverage ratio. Interest coverage ratio equals EBIT divided by interest expense. The interest coverage ratio shows whether a company has enough earnings to pay interest on outstanding debt. EBIT means earnings before interest. The higher interest coverage ratio is better. Debt to EBITDA ratio. Debt to EBITDA ratio equals total debt divided by EBITDA. This ratio indicates how many years it would take to pay off all debt if EBITDA is used entirely for debt repayment. A lower debt to EBITDA ratio is better. Efficiency ratios. Efficiency ratios measure how well a company uses its assets and manages its liabilities. The higher these ratios are, the more efficient a company is using its assets. Key efficiency ratios include 1. Inventory turnover, 2. Accounts receivable turnover, and 3. Asset turnover. Here's some additional insights on efficiency ratios. Inventory turnover. Inventory turnover equals cost of goods sold divided by average inventory. Higher inventory turnover ratios indicate more efficient inventory management. Accounts receivable turnover. Accounts receivable turnover equals revenue divided by average accounts receivable. This ratio measures how quickly a company collects payment from customers. Higher accounts receivable turnover indicates faster collection of receivables. Asset turnover ratio. Asset turnover ratio equals revenue divided by average total assets. Asset turnover indicates how efficiently a company uses its assets to generate revenue. A higher ratio indicates more efficient use of assets to generate revenue. The last set of ratios we will look at are market value ratios. Market value ratios. Market value ratios assess a company's stock price relative to financial metrics. Key market value ratios include 1. Price to earnings, P/E ratio, 2. Price to book, P/B ratio, 3. Dividend yield. Let's dive a little deeper into market value ratios. Price to earnings, P/E ratio. Price to earnings, P/E ratio equals market price per share divided by earnings per share. The P/E ratio indicates how much investors are willing to pay for each dollar of earnings. The P/E ratio is one of the most popular ratios used among investors to gauge how a company's share price is performing relative to its earnings. Price to book, P/B ratio. Price to book, P/B ratio equals market price per share, book value per share. The P/B ratio compares a company's market value to its book value. Book value is total assets minus intangible assets minus total liabilities, and shows the historical cost of a company's physical assets. The P/B ratio is measuring how much investors are willing to pay for each dollar of the company's physical assets. Intangible assets are excluded from the calculation because they are not physical assets. Dividend yield equals annual dividends per share divided by market price per share. The dividend yield shows the return on investment for dividend-paying stocks. Those are the major categories of financial ratios. Let's now take a look at how to interpret those ratios. Interpreting financial ratios. Take the following steps to interpret financial ratios. 1. Compare ratios to industry benchmarks. If ratios are significantly higher or lower than industry norms, you should investigate further to see if there is an issue with the company's operations. 2. Analyze trends in ratios over time. 3. Consider the company's business model and strategy when analyzing ratios. 4. Use multiple ratios for a comprehensive view. 5. Be aware of potential limitations or manipulation. Limitations of financial ratios. Financial ratios do not come in a foolproof case. Ratios should be analyzed on a combined basis, and not in isolation. One ratio by itself will not tell the story of what is happening in a business. Here are some things to consider about ratios. Ratios are based on historical data, and may not accurately predict future performance. Different industries may have different ranges for the same ratios. Ratios can be affected by accounting methods or one-time events, so be on the lookout for these. Ratios may not capture intangible assets or market position. Ratios should be used in conjunction with other analytical methods. Now let's look at an example of how we can apply financial ratios in a real-world situation. Practical application example. ABC Company. Current assets, $1 million. Current liabilities, $800,000. Inventory, $175,000. Revenue, $1,500,000. Net income, $250,000. Total assets, $1,250,000. Shareholders' equity, $1 million. Let's now calculate and interpret some ratios. Current ratio equals 1 million divided by 800,000 equals 1.25. Interpretation. This means the company has $1.25 in current assets for every $1 in current liabilities, indicating good short-term liquidity. Quick ratio equals 1 million minus 175,000 divided by 800,000 equals 1.03. Interpretation. This means that even without relying on inventory, the company can cover its short-term liabilities. Net profit margin equals 250,000 divided by 1,500,000 equals 0.17 or 17%. Interpretation. This means the company generates 17 cents of profit for every dollar of revenue. ROA equals 250,000 divided by 1,250,000 equals 0.20 or 20%. Interpretation. This means the company generates 20 cents of profit for every dollar of assets. ROE equals 250,000 divided by 1 million equals 0.25 or 25%. Interpretation. This means the company generates 25 cents of profit for every dollar of shareholders' equity. Financial ratios are powerful tools for analyzing a company's financial health and performance. However, they should be used as part of a broader analysis that includes understanding the company's business model, industry trends, and economic conditions. When used correctly, these ratios can provide valuable insights for investors, creditors, and management alike, allowing them to make better investment and management decisions. Financial ratios should be in every business toolbox. Learning to use them will put you ahead of the financial game. And that's a wrap for this video. Please share the video with your friends and colleagues, and do remember to like, comment, and subscribe. Let us know which topics you would like to see us cover in the future. Until next time, take care of yourself.